Hello everyone, welcome back to this special lecture series on economic survey for Prelims 2025. After the pandemic, the number of people who are interested in the financial markets increased significantly, which brought some regulatory challenges. And therefore, there are a lot of news items that came up, and UPSC also adapted by asking a number of questions on the basics of the financial markets. So in this video, we'll be just looking at the previous year questions, the trends therein, and what economic survey is saying on these financial markets. So let's begin this lecture. First of all, what is a financial market? Okay, let's look at the definition here. It says that it's a mechanism. What does that mechanism do? Exchange of financial aspects between participants. Who are the participants? You have the buyers and sellers. That is what a marketplace is all about, right? But what is the core function here? Efficient allocation of capital. So what is the takeaway? We understood the definition. In the context of financial markets and economy, we are just looking at efficient allocation of capital. We will see what that is between buyers and sellers. Okay. Let me help you explain this with a brief example. Let's say you are an entrepreneur. You want certain amount of money to start your business. Where will you go? You either go to the bank, or if the bank denies, you will have to borrow from someone else. What if you borrow from people who believe in your idea? That is the place where financial markets come into the picture. Let's say you pitch your idea to the market. You say, I'm betting on a certain idea. I want people to invest. Let's make money together. If the business succeeds, you get a part of the ownership and you get a part of the profit as a result. That's basically how financial markets function. But this is an oversimplified scenario from an entrepreneurial standpoint. But look at the investor. Normal people like you, me, everyone else, we are called retail investors. These people have only one agenda. They want to maximize their profit. They're not interested in ensuring a business growth or etc. because that's not their job. It's the job of the business to ensure that their business grows. So an investor always only looks at one parameter, safe return on investment, and they want it as much as possible. So market is about balancing between these two forces, the buyers and the sellers. And here is where the state comes into the picture. So when you have to take a look at the elements of the financial markets, as you can see here, you have buyers and sellers, you have assets. Basically, financial market is not just about loans. It is also about giving ownership. It is also about using some collateral to raise capital. All this we will be looking at it. So there are certain asset classes that we have to understand. And to facilitate all this business, we need some middlemen, intermediaries. They can be banks, they can be brokers, whatever. You need the digital infrastructure, physical infrastructure. These are the stock exchanges, clearinghouse, payment systems, etc. We'll get back to that. And finally, most importantly, you have the regulatory structures in the form of SEBI and RBI. So overall, we have to focus on this regulation and governance because that is what the state's purpose is all about. In this video, we'll be looking at the previous year questions, the basics tested by UPSC, and what economic survey says on this aspect of regulation. What are the various news items that are coming up on this? Where can you expect some probable questions? This is the scope of the video. Moving on. See, this slide is extremely important for you to understand some basics. Two fundamental forces driving the markets. Basically, like I told you, market is a force between two opposing interests. People who want money want it more than anybody else. Like they try to maximize the inflow. If you're an entrepreneur and if there are two businesses competing for the space, they will do everything in their control to ensure that the capital flow is in the direction of their own company. And if you're an investor, you want to avoid risk as much as possible and get maximum amount of profit. So the balance between this A and B will decide how the market functions. The market forces will take care of itself. And there is only one mantra here, survival of the fittest. Let's see how it works. What are the different ways in which capital movement or companies try to seek money? Equity markets. Equity market means, let's say for example, I will give you 10% of my company in return for certain amount of money. That is equity. Equity means you are getting a part of the ownership of that company. Debt market means, let's say there is a bond. On a legal paper, this is the most important point. It's a legal paper. You say that, hey, I'm taking 100 rupees from you, but I will return that 100 rupees along with 10% interest year on year. Every year I'll give you 10%. That is a promise. That is a debt. Then you have money markets. Let's say, for example, if you are running a business, let's say a normal kirana store. This is the case with most of the rural India, and has been the case even in urban centers a decade ago. People especially the Kirana store owners, used to lend goods. There is a credit cycle. You take the goods now. When you get your salary back, pay back. This is their way of ensuring that the customer is not leaving. Same mantra is now being followed by a lot of e-commerce stores. You have buy now, pay later schemes. More or less the same. But what if the consumer loses his job? There will be a difficulty for cash flow, right? Similarly, just like how a Kirana store will not be able to afford the goods for the next month because the cash flows has not come from the consumer, even market players, whether it can be banks or any other financial player, they will also have certain small time crunch. Money markets will try to address that. Always remember, this is something very short term only. Similarly, you will also have foreign exchanges. These are the places where, let's say you want to go to the US and you want to convert your dollar when you're coming from the US. This is the place where that exchange happens. Or this is a very crude example, but if you want to trade in the fluctuations that are coming because of the exchange rate variations in the market, this is the place that happens, where that transactions happen. Financial market, when an entrepreneur wants to attract money, he will do everything in his control to attract that money. And as an investor, we will do everything in our control to ensure that our risk is managed. We don't want to lose our money, right? We want to maximize our returns. What are the strategies that we follow? This explanation is about risk management. So we are discussing basic strategies. Each of this can be a definition based questions. UPSC can interchange the options, statements, etc. and confuse you. Please pay attention. So when you say hedging, it's like reducing your risk. What is the methodology used? Derivative trading. What is derivatives? We'll get back to that. Second one is diversification. There are various asset classes. You have gold, you have real estate, you have equity, you have fixed deposits. All those things which can earn you wealth, they're considered asset classes. If you want to divide your, let's say you have 100 rupees of savings and you want to invest this and ensure that the money is not lost, the strategy that you follow here is called diversification. You invest in gold, certain 20 rupees in gold, 20 rupees in real estate, 20 rupees in stock market, 20 rest of the amount in fixed deposit. The ratio might change according to your risk appetite, but the underlying funda is you are not exposing yourself to a risk element completely in one sector. What if the real estate crashes? What if the gold sector crashes? What if equity market crashes? So this is like not putting all your eggs in a single basket. That's one way to avoid risk. The next thing is speculation. Okay, let's say you believe that a certain stock or a certain asset class, to be very broadly speaking, gold will increase in the future. Real estate might increase in the future. Or you think that a certain share will increase in the future and you are investing that money there. It's a risk mitigation strategy. And finally, arbitrage. Let's say you buy something for 100 rupees in one market and sell that in your local market for 150 rupees. This age-old method of trading based on the price differences between the markets is called arbitrage. This can be a definition-based question also. So these are all strategies. Please pay attention. We are talking about strategies. Now coming back to the most important risk reduction strategy, that is hedging. Hedging is basically done on a concept called derivatives. Let's understand this concept of derivatives. And you hear in this context because there is a lot of discussion on something called as futures and options. SEBI is worried about a lot of traders losing their money by investing in futures and options. Why does it happen? You just need to know the basic definition of it. Let's try to understand. Okay. So what is a derivative here? Derivative basically means it's a contract. A contract that is based on something else, an underlying asset. Let's say if it is a stock derivative or equity derivative, then it's called an equity derivative. If it's based on gold, it's called gold derivative. If it's based on, let's say, house loan paper, it is called that. Whatever may be the underlying asset, it can be based on anything. That is a derivative. So it derives its value based on the asset that is underlying it. And it's a contract. Why do we enter into a contract? Basically, I told you, right? This is a risk mitigation strategy. It's like an insurance. It's like an insurance policy against the risk. How does it function? Let us understand. Basically, there are two kinds of contracts here in derivatives. They're called futures and options. Futures means, let's say you take a look at a price. Let's say you take the example of a gold class here. Today the price is 85k, and if that price increases to 90k in next month, you are basically losing some amount, right? But what if it crashes to 80k? What then? You never know. You might be losing 5k there also. So you take a bet. If you think that the asset price is going to increase, you enter into a contract with a person who believes otherwise. So a person X believes that it will increase. A person Y will say that it will decrease. So based on their respective speculation and risk appetite, they will enter into a contract saying that, hey, if the price increases to 90k, you have to sell it to me at 85k. This is the contract. And Y enters into a contract saying that, hey, if the price falls to 80k, you still have to buy the commodity at 85k. That way, both the parties will be happy. Okay, this is how they enter into a contract based on a fixed selling and buying price at a future point of time. And that's why it is called a futures contract. Now, the other thing is an options contract. Options again has two kinds of things: call option, put option. These definitions can be very important for your prelims examination. So please pay attention. When you are talking about an options, the first thing that you need to know here is that this is based on a right. You have the right as per the contract. There is no obligation to exercise that right. Okay, let me help you understand that. Let's take the example of the first kind of option called the call option. In the call option, you have the right to buy. In the put option, you have the right to sell. Please remember this. We'll get back to that. What is a call option? Let us see. Let's take the example of a stock, Reliance. Today, if the price is 2,500 rupees, you are speculating that it might increase. That's why you are taking a call option by paying certain amount of premium. Something called lot size is there. So you have to buy a minimum lot. In this case, 100 shares. So for each share, the premium is 100% to enter into that contract. How much are you going to pay? 10,000 rupees. So you pay 10,000 rupees and enter into a contract call option, and that will expire in 1 month. 1 month exactly from the date you entered into that contract. 1 month later, if the stock price increases, let's say from 2,500 to 2,700, then the profit that you will be getting here is 200 rupees per stock, right? Since you entered into a contract saying that irrespective of what the price is in the future, it can be 2,800, 2,700, whatever, it increased, right? I will buy only at 2,500. And that's why I'm paying a premium. It's like an insurance premium. So the person who is buying this will make some profit. How? He has a lot size of 100 shares. So he got 200 rupees profit on one share when it increased to 2,700. So since he will buy it for 10,000 premium, the net profit will be 10,000. 20,000 minus 10,000 for premium, 20,000. Let's say if the stock comes down to 2,300, who will buy when the stock price is 2,300 for 2,500? You wouldn't buy, right? Then the loss will be just the insurance amount paid. That is 10,000 only. In this way, you are avoiding the additional loss that you might be having. You are minimizing the loss. That is derivatives, a risk mitigation strategy. Now, let's talk about a put option here. Instead of saying that you're betting that the stock price will come down, then if the stock price comes down to 2,300, in this case you have lost 10k. In this case you will gain 10k. So in a put option, you will gain if the market falls. In a call option, you will gain if the market rises. You might be thinking that, hey, you said that put option is a right. You have the right to buy at 2,700, but will you? When the market price is this, why will you buy at a higher cost? You'll basically lose the money. It becomes worthless. That is how derivatives function. Now let's take a look at the types of financial markets. Basically, it can be divided into 4 categories. And the first one being capital market. Let's say you're an entrepreneur and you raise certain amount of capital from the market. Is it like today the market gives you 100 rupees and expects you to double it the very next day? No, right? You use that capital to buy your equipment, to manufacture it, to sell it. All of this will take certain amount of time. Therefore, capital markets are always long-term fundraising only. Please remember this. It's not meant for short-term. Stock market is where you will buy equity, that is an ownership in a company. Now here is where you have to understand the difference between a primary market and a secondary market. Let's say the primary market dealers buy this equity and they bring it to the secondary market. Let's say they brought it at 90 rupees. They'll bring it to the secondary market and sell it for 100 rupees. They are interested in immediate profit. A person in a secondary market will again sell it to someone in the secondary market again on a future date. Let's say on 10th of March, this is 90 rupees. On 11th of March, the primary player brought it to the secondary market and sold it for 10 rupees profit. Here, if I am that player, that secondary market player, I will wait till 13th to, ensure that this price rises further along with the other market players and sell it for 120 rupees. This is how respective people in the stock market will make money. Just understand the difference between the primary market and the secondary market. In the primary market, you have big institutional investors like banks, investment companies. Only they will be able to invest here. In the secondary market, normal people like you, me, everyone, retail investors will participate. So this is the equity market. Then you have the bond market. What is a bond market? It can either be a government bond or a corporate bond. Let's say a very good company like Tata or Reliance, etc., will issue a bond saying that, hey, I want your money. In return, I'll give you 10% interest. People are more likely to invest in these bonds because they have a good track record. If I am going to start the same company and if I'm going to say I'll only offer 10%, people may not be interested because I don't have a proven track record. So they will demand 30-40% interest. Just giving a rough numerical example. Higher interest basically. And this is where credit rating agencies come into the picture. It's like these guys are movie critics. They're like movie critics. They tell you whether this company is worth investing or not. So their reports are taken seriously. In the previous economic survey, there has been a criticism that there is a favoritism shown by this Western credit rating agency companies towards the Western companies and a bias against Indian companies. This is what was discussed. So you need to know what credit rating agencies are. There have been questions in this. That's all. So this is the capital markets that we're talking about broadly. Now, moving on. Next up is the money markets, where you are talking about the short-term liquidity. Here, instruments like treasury bills, commercial papers, call money market, all of them, they are about short-term. Like I told you, if there is a fund crunch, just like how in a Kirana store in your 90s and even rural India today, you would see that Kirana stores would lend certain amount of money goods. They'll lend certain amount of goods to households and say that after you get your salary at the end of the month, you can pay this back. What if the consumer loses the job and there is no fund flow? There is a short-term crunch for the Kirana store owner because he will not have the capital to buy the goods for the next cycle. Similar situations are also faced by financial institutions, and money markets are meant to address those short-term liquidity gaps. What are the tools? Treasury bills. This can be as short as 14 days and up to 90 days also. So commercial papers, call money market, treasury bills, all of them are meant to manage liquidity. Just ensure that there is a smooth flow. It's like, just like in a gutter, if something stucks, right? You have to ease it out. This money market plays that role. Foreign exchange market is nothing but, a place where, let's say, you are going to the US or someone is coming from the US in a very simplistic way. They want to exchange their currency for the local currency, and there will be an arbitrage here. Like there is a difference in how much you will charge for it. That's also where they'll trade this foreign currencies, and small differences will be the profit. So this facilitates international capital flow. I have given you a very oversimplified example. Please don't take it literally. And then finally, we have the derivatives market. We have discussed futures and options. Okay, all of this happen in the derivatives market, and these are meant for hedging risk, better price discovery and speculation. So all these markets are hitherto scattered. They're not at one place. When you bring all of them together, it brings ease of, making transactions and investing in the markets. And that's exactly what players like Zerodha are doing. Take a look at this. They provided a single digital platform for all the markets to come together, and that's the reason they have a market share here, Zerodha, headed by Nikhil Kamath. So you understand that there is a term called retail broker. It's made for people like you and me. So This is not meant for institutional investors, etc. It's meant for retailers, and that's the reason why Zerodha is called a retail broker. This definition can again be important. Moving on. So you have seen that there are various market segments and there are certain regulatory bodies and legislations that back them. We are using this opportunity just to understand what those bodies are all about. See, when it is about equity trading, the regulator is SEBI. You have seen the Harshat Mehta scam, right? Or scam 1992 TV show. If you have seen that, you understand the importance of a regulator in this particular case. There is an act, SEBI Act 1995, and if you want to enforce it contracts, there is another Contracts Act 96. When it comes to bond investments, government bonds are dealt by RBI and corporate bonds are obviously dealt by SEBI. You have the respective laws for the same. And for short-term investments, it is something that has got to do with money. And when it comes to money, RBI is involved, RBI Act. And when it comes to foreign exchange markets, you will see that currency derivatives, etc., are held both by RBI and SEBI because there is a possibility of money laundering whenever this kind of foreign exchange is involved. So RBI wants to ensure that is not happening. And derivative markets and depository services are the two other segments that we need to know. When it comes to futures and options, it's SEBI. And when it comes to demat accounts, what is a demat account? See, here there is an organization like CDSL, Central Depository Services Limited. Prior to the digitalization, people used to carry this physical papers. Demat literally means dematerialized. So we have opened digital accounts. All that infrastructure and all the servers should be maintained by a company, right? That company is a depository service and CDSL is one such company. It is regulated by the Depositories Act 1996 and the whole functioning is taken care by SEBI. Regulated by SEBI. With this understanding, let's try to solve some previous year questions. Firstly, let's take a look at this. With reference to Indian economy, collateral borrowing and lending obligations. See, borrowing and lending is something that has got to do with, a short-term kind of a thing. Right? When do you put some collateral? When there is an emergency. When will you have an emergency? When it is a short-term urgent kind of a thing. So it cannot be stock market. It cannot be a bond market because these are meant for long-term. They are well planned out. You raise money in capital markets to build a business, not for an emergency. Forex market is meant for arbitrage. It's not meant for, emergency again. Money market is the short-term market which will facilitate this borrowing and lending. So this is how you have to take clues from the questions and try to answer them. Okay. Now, if you haven't watched the previous years banking and non-banking companies, the classification, etc., I will be attaching a link here. You can go back to the basics of the banking and types of banking and the regulations therein. You'll be able to solve that. But what is the takeaway here? Look at the logic. NBFCs and liquidity adjustment facility. Just like market players, even NBFCs who are not present in the market, they can also have certain financial crunch, right? Banking companies will also have some financial crunch. To ensure that situation is addressed, RBI came up with something called liquidity adjustment facility, but it is not available for NBFCs because the mechanism says that it's meant for banks to tap in their SLR reserves. Like banks are forced to invest in government securities just as a safety net. In times of this emergency, RBI will take this government securities and give certain amount of money. But NBFCs are not expected to maintain this statutory requirements like CRR or SLR. They have other facilities like TLTRO, etc., which was explained there. You can go and visit that lecture. Now, let's take a look at the next question. Okay. Previous question, let's see once again. Second option. In India, foreign institutional investors can hold the government securities. Why not? They can hold. In India, stock exchanges can offer separate trading platforms for debt. Yes, that is also possible, right? So you have the bond market, you have the equity market. Stock exchanges can handle both. The first point is the illogical point that you can remove. And therefore, answer is 2 and 3 only. Now, let's take a look at this third question. In India, which of the following can trade in corporate bonds and government securities? Like I told you, retail investors, these investors, they do not have a lot of faith in financial markets because of the scams like Harshat Mehta scam, etc., Ketan Parekh scam, etc. Only recently, after the pandemic, government started giving access. It facilitated conditions for retail investors to participate for deepening of the financial markets in our country. Compared to developed countries like US, India has only 3 to 4% of its population investing in the markets. You can imagine the kind of depth we will have. We don't have to borrow from elsewhere if people start, investing as a habit. And we realize that, and that's the reason why we are going ahead with this agenda. Now, when it comes to insurance companies, pension funds, retail investors, all of them invest in companies because they want certain amount of returns. Insurance companies don't want to sit idle with their money. Pension funds want to make money from all the contributions that they're getting so that they can pay that interest back to the pension holders. And then retail investors also want to increase their wealth. And why not? Why not corporate bonds and government securities? Is there any logic for restricting them? No. So that is the reason why you will have, all the three sectors being a part of this. In 2021, you've had a similar case where a question on retail investors was also asked, because that year RBI allowed retail investors to invest in government securities. And that platform is called Negotiated Dealing System Order Matching. I've posted this on the Telegram channel as well. People back then noted it down and a lot of people got it right as well. So take a look at this. CDSL is jointly promoted by RBI. Why will a regulator operate any depository services? Why will it take that headache? That's not the case. So if you eliminate this, you are left with 1 and 2 only. It's as simple as that. Now let's take a look at this next question. You have 3 different option statements here. Which of the following are considered to be financial statements? Exchange traded funds, currency swaps, and motor vehicles. I told you, right? Financial instruments are those with legal documentation. There should be a contract between two parties for generating wealth or for financial transactions to happen. Exchange traded funds are like an agreement between investors and the people who are seeking that money. Currency swap is also like an agreement between two parties. But what about motor vehicles? It's not exactly a legal document or a financial instrument because there is no contract involved. You are not, using this to allocate capital or anything. It's just a commodity. So if you eliminate that option, you are left with 1 only and 1 and 3. Is there a logic for you to eliminate currency swap? No. Because like I told you, it is also a contractual obligation and therefore it is a financial instrument. 1 and 3. Let's take a look at this question. Government bond market, call money market, treasury bill market, stock market. Which of them can be included in capital markets? Capital market is the one which is a long term. Can you think of treasury bill market as a long term thing or a call money market? No, right? For the obvious reasons that we discussed already. These are meant for short term liquidity challenges only. So only 2. Okay. Now, in this question, in the context of finance, the term beta refers to what? If you take a look at this question. Here, beta is this is a very difficult question for people that year. In this case, if you notice alphabet, alpha, beta, gamma, delta, this word delta indicates the difference between what you think it is and what it actually is. This gap indicates a numerical difference. This is commonly used. So, if you read the options, it's a very difficult question. I'm not saying it is easy to guess like this, but if you were to focus and derive an answer, let's read each of the options carefully before giving up. The process of simultaneous buying and selling of an asset. What is this called? It's arbitrage. I've already told you. This is not the answer. An investment strategy of a portfolio manager to balance risk versus reward. Did we discuss any such strategy named beta? No, right? It's not there in the usual textbooks. A type of systemic risk that arises where perfect hedging is not possible. Let's say COVID lockdown. This is a systemic risk. It's called a black swan event, for example. That risk cannot be quantified. It cannot be anticipated. So it's not a numerical number. Unlikely that this will be the answer. And finally, you take a look at the numeric value here. It measures the fluctuations of a stock to changes in the overall stock market. Plausible, right? So if you were to take a guess and if you have the appetite to take that risk, this is how you are supposed to take. So these are some of the basic questions which can be solved with bare minimum understanding of the financial markets. Now let's talk about the next concept of bond and interest payment yield. This is another concept that can be asked in UPSC. So I'm explaining this here. There were PYQs on this topic. Now, what is a bond? Let's say you are a company owner, like I've already explained. you want certain amount of capital, you go to the market and say that I'll give you some 10% interest. Okay. With that 10% interest, I'm going to make, as an investor, I'm going to make certain amount of money. And after a fixed period of time, I'm going to get the entire payment that I've made. Like if I'm paying 1,000 rupees for that bond, I'm going to get that back also. It's a very safe investment. So if a company issues a 1,000 rupee bond and people are willing to pay 1,200 rupees for it, why are they willing to pay? Because they think it is a better option than any other option that is available in the market. So essentially, for that person, the yield is coming down from what is, the case for the previous investor who bought it at 1,000 rupees. So for 1,000 rupees is getting 60 rupees annually. But now I have to pay 1,200 for the same 60 rupees. This means that when a bond price goes up, whenever there is demand, yield comes down. Similarly, if the bond price comes down, yield goes up, because now I'm paying only 800 rupees and I'm getting 60 rupees annually because the interest rate is 6%. This is the concept of bond yield. Now you have to understand certain concept that governments continuously keep on, investing, and therefore they always want to raise more and more amount of money. Let's say if a bond which is supposed to mature in the year 2030 is trading at 10% interest rate. Okay. And if a government issues a bond for a future point, new fresh bonds for a short term, 2026. Okay. Since I am taking a risk for a very long time, I am expected to get a higher return on interest. And for short term, the interest return will not be that high because you're only taking the risk for a small amount of time. But sometimes it so happens that for short-term bonds, market is reacting in such a way that they are willing to invest in short-term bonds rather than taking a risk of betting on a long-term bond. Is this even possible? Is this even logical? Yes, it is logical when people lose faith in the long-term ability of that economy. If they think by the year 2030, US economy is going to drain, it doesn't matter how much interest that economy will pay, that bond will pay. People are simply not willing to invest. So this is called inversion, yield inversion. So this is a scenario where short-term bonds are much more lucrative than a long-term thing, which indicates the unhealthy sign of an economy. This means whenever this happens, there is a recession, a slowdown in the economy that is just around the corner. When your short-term bond yields are higher than the long-term bonds, it means the economy is going into a recession. Please note this point. This is one question that can be asked. Now, what is the impact of inflation on a bond? What is inflation? It's the price rise, general price rise over a period of time. Now, let us understand the impact of inflation on bond prices. Okay, basic funda. What is inflation? A rise in the prices of a commodity. In an economy, if inflation rises, obviously the bond should offer more than what the inflation is about. Let's say, for example, if the inflation is 5% at this point, and at a future point, the new bond should give at least 7% because it has to beat the inflation. Now, when in a rising inflation scenario, the new bonds will be much more lucrative than the old bonds, and your old bond prices will fall down. People have limited money. They cannot invest in old bonds and new bonds also, right? So they will find the new bonds more lucrative. So the old bond prices will fall down. And in a situation where inflation is low, let's say your old bond price is 5% and the new inflation is 3% and bond price is also somewhere around 3.5 or 4%. It means the new bonds are paying low interest than the older ones. So the bond price of the old bonds will increase. This is the logic for bond price and inflation. If you understand this concept, you can solve almost every question that is out there. Now, let us have a look at what the economic survey says on this concept. Now, I have taken some important points from the economic survey, listed them down here, which can be relevant for our prelims examination. I'm not going into an in-depth analysis. Let's focus on ROI, return on investment, since we're talking about financial markets. Anyway, economic survey points. What does it say? The first point that you need to know, the fact, corporate bond market in India is much lesser than the equity market. It's roughly around 18% of GDP. But if you take the same thing in Korea, it is 80%. And if you take the same thing in China, it is 36%. This fact needs to be known. Deepening of bond market is a long-term theme which we are trying to achieve. We have not achieved it yet. We are moving in that direction. All the current affairs that you would see if you're preparing for 2026-27, this is a very important theme. Measures taken by the government of India for deepening of bond market. You can expect questions for prelims and mains here in the future. Second point, gift city. If we want to attract investments into Indian economy, one of the biggest hurdle is lack of ease of doing business. If you want to make India a financial hub, you need to have an international financial services center, a city like that. Gift City in Gujarat is one such center. So survey says that after the establishment of IFSC authority, which is like a unified regulator which does the role of SEBI, RBI, insurance regulator, pension fund regulator within the Gift City, after that was established in 2020, our position as a global financial hub increased and we are now at a 52nd position. Okay, we are at the 52nd position in total. Now, when you take about the insurance sector, this is the next point that the survey talked about in the financial markets. Our penetration came down. Insurance penetration. What does it mean? If you're paying some amount of X, if you club all the insurance premiums paid by the consumers or the clients of that company, all the companies put together and divided by the GDP, you get the insurance penetration. It's a measure of the population or the amount of risk that is covered for that economy. This came down. Global average is somewhere around 7% and India's average is 3.7%. This stats can be very important for your substantiation in mains exam also. Now, when it comes to density, which is a measure of affordability, how do you define that? It is as you can see here, it is the total amount of premium divided by population. It's a measure of access and affordability. Density is increasing. This is what the survey says. Meaning that people are spending more amount of money on insurance products. Awareness is increasing, but it is not enough. It is still low. Next important point that you need to know with respect to lending is the concept of Open Credit Enablement Network, OCEN. So how does this work? See, India in the past few years has come up with fintech revolution. With the advent of UPI, we have literally set high standards for the world. In terms of lending, what is the biggest problem between lenders and borrowers? Lack of trust or lack of trust on the ability of the borrower to pay that money back. That's why we are depending on third-party agencies like credit rating agencies, CIBIL score, etc., etc. Now, I'm not saying that is completely unnecessary or anything, but we can come up with a real-time framework, right? Let's say you are on an e-commerce website like Amazon and you want to buy some product, but you don't have the money to buy that product right now. Or let's say you are a small MSME. You want to buy something from a bulk supplier on an e-commerce website like IndiaMart, but you don't have the credit right now. No bank is willing to take a bet on you. What would you do? This is the problem that OCEN is trying to solve. By taking account aggregators, let's say for example, you have CRED, which has all the data. It studies and comes up with its own methodology for ensuring that credit profile to build the trust on a borrower and gives it to lenders like banks, NBFCs, etc. Then these banks will directly integrate with websites like e-commerce and ensure a real-time disbursal of funds depending on your credit profile. So, lack of access to credit is no longer a barrier for small MSME companies which are good enough to, grow. This is how OCEN is going to work. This is a concept discussed in economic survey. These are the only important points which can be asked from a prelims perspective. So, I hope you covered this entire chapter comprehensively, the financial markets, the definitions, the concepts that are discussed in the economic survey, and revise them together. You can also join the Telegram channel that the link for which is posted in the comment box below or the description box below. You will get the PDF of this lecture as well. Stay tuned for more lectures and also stay tuned for the free prelims current affairs series along with economic survey series. That's it for now. See you soon.